The global pandemic compelled individuals worldwide to confront economic instability, leading us to ponder our financial well-being. In this era, where prioritizing low risk and favorable returns holds greater significance, now is the perfect moment to delve into the question: what exactly constitutes real estate debt? Come along with us as we delve into the intricacies of real estate debt, exploring both the potential hazards and advantages associated with this investment vehicle. What is real estate debt investing? The mere mention of real estate debt often triggers a visceral response in most individuals. We tend to harbor reservations about debt, yet these sentiments might not accurately capture the essence of debt itself. As responsible consumers, it's prudent to steer clear of needless and burdensome debt. However, what transpires when we shift our perspective from that of a consumer to a lender? This shift in mindset is paramount when delving into the realm of real estate debt investment. It allows us to comprehend how this financial approach can deliver favorable outcomes both for you as an investor and for those you empower to achieve their dreams of homeownership or business establishment. Real estate debt funds represent discrete pools of private capital, fortified by equity, designated for providing secured loans to commercial real estate borrowers. Typically, these real estate debt investments are tailored to specific lending strategies, such as shopping centers and multifamily real estate developments. They encompass a range of financial instruments, including bridge loans, commercial loans, and property rehabilitation loans. In the discourse surrounding what constitutes real estate debt, it's crucial to draw a clear distinction between real estate debt investing and equity investing, elucidating your distinct role in each. In the realm of debt investing, you take on the mantle of a lender. Conversely, in equity investing, you become a stakeholder in the property itself. Real estate debt strategies come with varying term lengths, ranging from a few months to several years, contingent upon the project's duration. Your return on investment is enshrined in a contractual agreement. On the other hand, equity investing entails a forward-looking assessment of a property's future value, encompassing higher risks and considerably longer investment horizons. Purpose of real estate investments. Real estate debt investments provide financing for a diverse array of commercial real estate undertakings. These investment endeavors are characterized by their relative security because funds are extended to seasoned developers and investors in strict accordance with prescribed lending strategies. Furthermore, an additional layer of protection is afforded as these loans are consistently backed by collateral, most commonly through trust deeds. Investors in commercial real estate debt stand to benefit from periodic payments originating from the interest payments made by the borrower until the loan matures. The attractiveness of these investments is further bolstered by the higher interest rates on offer, typically ranging between 9% to 12%, ensuring a substantial and appealing return on investment. In the unlikely scenario of a developer's default, the security of your investments remains intact, as the fund will seamlessly assume ownership of the collateral provided by the developer. Trust deed investing. In the quest to uncover the essence of what constitutes real estate debt, it's imperative to recognize that the bedrock of security in this form of investment hinges on the proficiency of the borrowers, and even more critically on the presence of collateral, often in the form of trust deeds. A trust deed, serving as the linchpin, legally transfers property ownership to a third party until the borrower successfully repays the loan. This is why you may frequently encounter the term trust deed investments used interchangeably with real estate debt investments. Opting for trust deed investments empowers investors with a higher degree of control and diversification compared to conventional stock and bond investments, thanks to their status as first position or primary loans. These investments are inherently short-term, accompanied by an annualized return on investment (ROI). Interest rates remain fixed, with the expectation that borrowers will dutifully fulfill their monthly payment obligations. In addition to the principal and interest, investors may accrue supplementary funds through service fees, exit fees, origination fees, extension fees, and modification fees. Pros and cons of real estate debt investing. As is the case with most endeavors in life, venturing into real estate debt funds comes with a roster of advantages and disadvantages. While some risks can be mitigated through well-devised real estate debt strategies, a discerning investor knows the importance of leaving no stone unturned. Let's delve into the merits and pitfalls. Benefits. Collateralized. The investment strategy of a fund, replete with explicit lending guidelines and a trust deed secured against tangible property, signifies that in the event of a borrower default, the lender can assume control of the property. This mechanism allows the fund to recoup any transient losses effectively. Short holding period. Commercial real estate debt revolves around development. Upon the completion of the real estate project, it is typically anticipated that the loan will be settled in full in short order. The holding period for these loans generally spans from 6 months to a few years. Steady income. Borrowers are contractually obligated to make monthly payments, thereby bestowing upon you a passive income stream. Your rate of return remains fixed, calculated based on the interest rate and the sum of money invested. Risks. Capped returns. The presence of a fixed interest rate imparts a sense of security, but it concurrently imposes a limitation on the potential earnings from your investment. Inflation impact. Inflation rates have a propensity to fluctuate, at times quite erratically over time. Such fluctuations can adversely impact the magnitude of your return on investments. Prepayment risk. While a borrower's early repayment of a loan isn't inherently detrimental to a fund, it does disrupt the flow of interest payments you've been receiving. In conclusion, we hope this exploration of real estate debt investing has shed light on a realm that often remains uncharted. Remember, understanding the intricacies of this investment strategy is the key to making informed decisions. And if you're eager to learn more about where to discover those elusive real estate deals, simply click on the video displayed on your screen. Happy investing!